Today is 14th November, celebrated as Children's Day. So today we thought that why not get on board Dhirendra Kumar from Value Research and talk about some investment plans that you could pick up for your children. We've devised it in such a way that we're going to classify the investment plans into two purposes. That's one for the child's education and the other for the child's marriage or whatever eventual plan they may have in life. And Dhirendra, morning, the first question on everyone's mind is, when do you start investing for your child? What is a good age? Dhirendra, can you hear me? I don't think my voice is reaching Dhirendra Kumar. We'll get to him in just a bit. But like I was saying, that we've classified our needs and purpose for the children's education or rather children's investment plan into two classifications. One for their education, in which we're going to ask Dhirendra Kumar, A, what's a good time? At what age for your child should you start looking at investing? And B, maybe derive some long-term mutual fund plans as well that one could invest in. So A, we've taken the long term if your child is under 5 years of age. So what's that correct plan that you should put in money for your child? B, if the child is say 10 years of age, assuming that you need the money when the child is 18 years of age. So where is it that you should be deploying money? And B, C, for the very short term, that if he's around 15 years of age and you need the money in the next 3 years for his higher education. So where is it that you should be putting your money? So that's the investment strategy that we've devised, and we're going to get on board Dhirendra Kumar in just a bit and get in some fun action or fun names from him. And that's exactly how we've devised even the investment plan when it comes to your child's future needs, assuming that you need that corpus at age 25. When is it that you should be starting investment? Under 5 years of age, where is it you should be deploying your money? Assuming that the child is 15 years of age, and then at age 20 as well, for the extreme short term, maybe the child would require that money for marriage purposes or for some other future goal that he or she may have, assuming that you require the corpus when the child is 25 years of age. So we're going to go across to Dhirendra Kumar, and this is exactly our strategy throughout the day today. Not just mutual funds, but we're going to get you on BNSN, the stock game, take some viewer queries as well. We've got a whole host of parents lined up who keep sending us their queries on whether or not this is a good investment, a stock or a mutual fund for their child's education or marriage purposes. So we're going to be answering all of your viewer queries as well, 11 to 12, and then throughout the day today we're going to keep the focus on children's investment plans. But Dhirendra Kumar is with us, so let's go across to him. Dhirendra, hi, morning. One wonders when investing for their children as to when is the right age. When should you start investing, assuming that you want to invest for your child's education for higher studies, that the child may need that money at age 18? When do you start investing?
As early as possible. In fact, even before the child is born, because for such long-term goals you need money needs to compound, and as early as possible that will give you the biggest advantage. Not necessarily if even if you don't choose the best investment, but if you give it time, the magic of compounding will work anyway. But more importantly, if you have some principles in place, one is that appreciate inflation. The biggest, an important goal like education, the kind of inflation that it faces or we have seen in last 15 to 20 years is very unusual. It is not the wholesale price index. The kind of the cost of education and the changing dynamics of education, it could be completely different. So factor in more and then be regular about it. It is not a one-time thing. What used to happen earlier, that the child is born, you make some investment, the grandparents make some investment, and that used to reasonably take care of things. No longer. You have to plan more meticulously and be more methodical about it. Give it as much time as possible. Earlier you start, the bigger advantage you will have.
Right.
And so deposits won't help. Fixed income for such long-term goals, if you get stuck with something traditional, saving won't be enough. You have to invest, and you have to invest in the productive assets. Avoid the same, avoid the usual thing. Gold will not help. Fixed income will not help, which means that you have to be methodical about it. You have to choose equity or any other real asset which will be able to beat inflation.
Right. So Dhirendra, let's start off with what you would expect or what you would advise for investing by parents for a child under 5 or up to 5. What are the funds that they can look at?
Investing for next 15-20 years, you have to go with equity, and equity you must implement the principles. More importantly, you have to avoid few things when you are in a fairly different emotional mindset when investing for a child, and many of the insurance plans or other such product with child embedded in the product name, they strike a chord with investors. One should generally avoid it. Ask some basic question that you are investing for such a long term. What is the cost? How will it generate return? So investing in multi-cap fund it's the simplest thing that you can do. Start a SIP, increase the amount if possible. If you are actually not able to do the SIP, then maybe for a 15-20 years, if you just invest a defined amount and increase it every year, even because investing for 15-18 years, an annual investment is also an SIP. If you actually make it a rule that you are unable to put together your savings for allocated to this, if you invest just on the child's birthday a defined amount and increase it by a certain percentage every year, that is your SIP, and if you keep doing it for 15-18 years, you will see the magic. Choose the multi-cap fund. This is the simplest way where you can diversify. Make sure that you are investing regularly, if not every month, every quarter, at least annually, and you will have reasonable comfort while the child has to go for education. My choice of multi-cap funds: Franklin India High Growth Companies Fund, ICICI Prudential Value Discovery, and SBI Magnum Multi-Cap Fund. These three funds are they follow a different strategy, but they carry a fairly diversified portfolio, and mixing two of these three funds will actually help you achieve superior diversification.
Dhirendra, what if you wake up late? At age 15, you realize that in the next 3 years, your child wants to go to an Ivy League. You need at least a minimum corpus of 1 crore rupees. What do you do then?
You can't do much, but optimize the return on whatever you can actually put together. Consolidate all your investments, all your savings wherever it's lying, and put it in an equity income fund. These funds typically invest 30-35% into equity, remaining in fixed income or arbitrage, and they generally give you the tax treatment of equity investment. So all the returns will be tax free. You will be able to beat fixed income return, what you will earn in fixed deposit. They are also reasonably liquid, and very likely that you will not need all the money at one go. So maybe even if the child's education is scheduled to start in 3 years time, you will still have 6 years time to pull out all your money. So expect 25% more return than deposit with zero tax with such investments. If I have to recommend some equity income funds, I will say HDFC Equity Savings Fund, the ICICI Prudential Equity Income Fund, and Reliance Equity Savings Fund.
Similarly, Dhirendra, if the purpose of one's investment for the child is for his or her marriage, or if at age 25 they want to look at buying a house, and as parents, you want to contribute into such a large investment of theirs or expenditure of theirs. So assuming you need the corpus in 25 years and your child is only under 5, you have enough time to plan for the investment. Where do you put your money?
Follow the same plan, because the principles driving these plans or the investments is straightforward. Investing for 10 years and more, diversify, invest as much in equity, and be regular with your investment. So take the same recommendations. Of course, as you get closer, you need to be little short. Maybe one can be little more aggressive. Planning, unlike education, the only advantage that you have is the budget can be negotiable. It can be little higher or lower, and even the timeline is not frozen. So you have greater flexibility with those spendings, the wedding spendings, and of course, you also have to factor in that if we are in a changed India 15-20 years from now, you have to make sure that you have all the money in a legitimate form where you have the money and you can spend it. It may not be the same as it is today.
Right. And so if you were to extend out that time horizon, Dhirendra, because 10-15 is something that 10 years and 15 years is something that I think parents is that phase of life where parents are more mindful of these investments. But what if you suddenly want a kitty to protect your child's midlife, either in their 20s or their 30s, and you start investing when the child is 20, then what are the funds that one can recommend for multiple purposes?
All investment should primarily be guided by the same principle that if you are investing for any goal which is many years away, be as much into equity. If you are in a time frame of 3 to 5 years, then be as conservative so that you are able to negotiate your goals better and you have greater predictability of having the money and it is not dependent on the state of the market. Sometime in between 5 to 10 years, be little conservative with the balanced fund, because you can't really give up on equity. At the same time, the rebalancing and simplicity of this, the tax efficiency will be very useful. So less than 5 years, consider these equity income funds. 5 to 10 years, be with balanced fund. 10 years and more, whatever be the time frame, planning for your child's retirement, his retirement, or down payment for a house which you would like him to buy, contributing towards that 10 years away. So take these buckets depending on the time frame. Less than 5 years, go with a extremely conservative these equity income fund, which is a third of it or may sometimes a quarter of it is in equity. 5 years and more and up to 10 years, consider those balanced funds. They are 2/3 into equity, 1/3 into debt, and more than 10 years, consider the multi-cap fund. This is the simplest plan which most investors can follow, and it can actually surprise them. And the bigger surprise or the reward of the reason for the surprise will be your discipline of being being at it, chalking out a plan and sticking to that.
Okay, Dhirendra, always good to have you on the show. Share with us your insights, mantras and wisdom on how to go about investing at this time.
Thank
a more
you.
responsible one for your child's future. Good to have you on the show, Dhirendra.